All right, so when you go about investing in mutual funds, you have two options. You can either purchase directly, or you can directly or on your own, or you can go to a mutual fund distributor who then helps you in picking up and investing in the right fund for you. Now, these intermediaries play a vital role in the world of investment, be in stock market, open market investments, or even mutual funds. So today on the Money Show, we will discuss all that you need to know about these intermediaries. And for that, we are joined by Radhika Gupta, MD CEO Edelweiss AMC, and Sanjay, Shah, MD Prudent Corp. Good evening and welcome to the show. Radhika, first question to you. Let's understand the role of intermediaries from an AMC point of view and from an investor's point of view, because in recent times, we've seen the industry has gained a lot from it. Even the investors post-pandemic have got more awareness about equity markets and investment in equity market through mutual funds. So how do you actually read this kind of an interest? Is it only the interest in the equity markets, or we are also looking at the financial literacy, which is the bigger goal?
So I think, Kavita, firstly, thank you to your team for touching on a very important issue of intermediation, which is less talked about. See, as a brand, as Edelweiss Mutual Fund, we have always had the campaign Advice Zaruri Hai, which talks to the role that intermediation and financial advice plays in an investor's journey. You know, post-COVID, especially more and more investors are at least aware of mutual fund investing, want to create wealth in the markets. But many times when we talk to them, they don't know how. They don't know how to get started. They don't know how to choose from a bevy of mutual fund products that are also increasingly getting more varied and more complicated. And while they may have heard of funds from their family or friends or neighbors or social media, they don't know what is right for them. And I think here is where a mutual fund intermediary, whether an advisor or distributor, can help you take a very valuable next step in taking this idea of mutual funds and helping you build an asset allocation and a portfolio that works for you, and then guiding you on how to use mutual funds to use your goals. Because finally, mutual fund is a little bit like that old children's toy Lego. It's a tool. You build what makes sense for you. And I think that architect can be a mutual fund distributor who can work with you. So that is something that we very strongly believe.
Exactly. I can see Sanjay agreeing to a lot of pointers that you've mentioned in this answer. But then, Sanjay, I just come to you. Before that, quickly, Radhika, what to look at when one goes to talk to an intermediary, or when one is thinking about going to an intermediary to make any financial investment purchase?
So I think choosing an intermediary is a very well thought out decision, and I give the analogy that the same kind of things you would look at in a doctor, in a family doctor, you should look at in a financial intermediary. To me, I think there are two parts to this. One is trust. You know, money is finally a business of trust, and you have to absolutely trust the person that you are talking to. So I always tell investors when they're talking to intermediaries, you know, when you're talking to an intermediary, this should not be someone who's trying to sell you a product. This should be someone who's trying to ask you questions about your financial personality, about your financial goals, and then building a solution that works for you. Just like medical advice, the right medical advice is the right one that is right for your body. The right financial advice is the one that is right for your financial conditions. And so that is the first element, trust and the ability to understand you, listen to you, and work around you. The second element is competence. Of course, in any medical professional, for instance, you look at competence. And I think the intermediary's knowledge of markets, market instruments, mutual fund instruments, instruments even outside mutual funds. You know, one of the things that has happened in a market like India, Kavita, since 2003 is financial products have evolved so much. In fact, mutual funds have evolved so much. At one time, you used to have only actively managed equity funds and fixed income funds. Now you have ETFs, index funds, smart beta funds, international funds, China funds, debt passive funds. So the mutual fund intermediaries knowledge and competence needs to shine through. Finally, you need someone who understands market, who understands and finance is a technical professional. It's this is not selling makeup. So I think that element of competence is extremely important. These are the single two things I would look for when I choose an intermediary.
All right, Sanjay, I'm sure you echo most of the things that Radhika is highlighting over here. And also, what I also want to understand from you is actually the way intermediaries work. You know, they play a very crucial role when it comes to investor education. That's clearly established. But then, what is crucial in the kind of services that intermediaries provide? What is the kind of expectation an investor should be having from an intermediary?
Point which Radhika said, definitely I'll fully agree with her as far as the importance of advisors. And I can tell you frankly, the advisor plays a very important role in the life of investors, because they starting from assessing the requirement to constructing the portfolio, doing the proper asset allocations, probably making sure that investor remain probably hooked to his goal in spite of there being a turbulent times, whether you are talking about the market up cycle or the down cycle. I think periodically assessing and rebalancing the portfolio based on his requirement. I think when as you are reaching closer to your goal probably you start tilting your portfolio towards more debt instruments so that your portfolio doesn't get impacted by sudden volatility. So there are n number of activities which advisor plays in the life of investors. So when you choose an advisor, probably you need to keep in mind that whether the advisor has that kind of experience or not, whether advisor is capable enough to do the proper risk assessment and the portfolio allocation or not, whether he is probably using the technology effectively or not. Same way what Radhika said is that now the mutual fund alone may not suffice the requirement of investors. Frankly, I believe mutual fund is a very prominent product, but still he should be able to take care of your taxation aspect, your protection requirement like your term plan or health insurance, or probably so overall probably we believe that the advisor stroke mutual fund distributors has to play a very holistic role when dealing with the investor.
Sure. Sanjay, if you just want to go back and help us understand how the entire concept of intermediary has also changed. I will be asking questions later on about the penetration and the kind of reach that intermediaries have. But then so far, if you just go back 5 years back, okay, how has the entire setup changed? If through example, you could just explain this to us.
So frankly, if you look at, there is a strong cult which has developed in the country about SIP. I can tell you frankly, maximum credit goes to the entire IFA community or the mutual fund distributor community, who played a very huge role of bringing retail investor to the SIP as a big instrument. Overall, if you look at in last 5 years, the share of IFA stroke mutual fund distributors in the overall asset management or the AUM, that share is now upward of 50%, which used to be less than 50%. So I think they play a very huge role of bringing money in the overall scheme of the thing. If you look at the overall equity, which is a very strong from the point of retail investors for a wealth creation, maximum contribution of retail IFA comes in the equity and the hybrid segment. So retail participation, penetration, I think the creating a cult of SIP to the ground level, IFA played a very important role in last 5 years. And I can tell you frankly, in last 5 years, because the way entire product basket and the availability is increasing, the need of intermediation and having the good quality advisor on your side is becoming very prominent now.
All right, let's move on. And Radhika, let's talk about penetration and reach. Now, specifically talking about small and mid towns and B30 towns, how are these places faring? You know, especially since the pandemic, we've seen the awareness really, the entire scenario has changed. What are the factors and how far have we come? A lot really needs to be done over here, but the kind of aim that, you know, jointly people like you and we have over here, you know, a broader picture of on financial literacy. This is probably the first chapter that we are on. How do you see it faring, and what are the expectation also of the people generally in B30 towns?
So I think there are a few things. One is that, look, India is becoming more aspirational, and that aspiration doesn't sit in tier one and tier two cities. So if you look at the B30 investor now, he or she is aware of mutual funds. Thanks to programs like Mutual Fund Sahi, so many fintechs platforms coming out, the awareness about financial instruments, about market wealth creation, about mutual funds, this has definitely increased. So aspiration levels, whether it's career or money, have gone up in all parts of India, including B30. In fact, when we look at mutual fund industry data for substantial periods, we see that while the base is smaller, B30 is growing at a faster pace than T30. That is happening. And the growth, I think fintech platforms, to give them credit, have done a wonderful job in sort of democratizing access to these things. So you no longer need a platform. You no longer need to fill up forms and do this. This all can be done digitally. So I think access and awareness are not a problem. What we do need, however, is that when people are coming in from these cities to mutual funds, they come in the right way. So, finally, I think an investor will make money in the market if they stay for long enough and enjoy the benefits of compounding. That longevity will only happen if you got the right kind of advice, if you've chosen the right products, if you've been handheld to stay through different market conditions. And that's where some of the fact that investors who are not fully aware are coming in without advice from these markets sometimes is concerning. So I always tell this group of investors that please look out for a good intermediary in your market. And believe me, I travel a lot of the country. They do exist. They are coming up.
Same question to you, Sanjay. How do you see B30 towns coming up? And in fact, when it comes to beating the urban areas also, what's the kind of investor we are looking at? What are their interest areas?
Look at overall B30, as Radhika said, I think that segment, or even B50, beyond 30 cities or beyond 50 cities, I think participation has been increasing at a rapid pace. But however, we feel that these are the guys who has been participating regularly through SIP. So overall SIP numbers are also increasing very, very fast in beyond 30 cities. And I can look at my number also. The participation of retail through SIP in the beyond 30 cities is increasing very, very fast. However, for us to have the significant growth of retail investors in the mutual fund industry, I believe fleet on street like the mutual fund distributors, that number is hardly about 1,35,000 today in the country. Against that, if you look at, there are almost 21 lakh insurance agents. So if we want that more and more people should come into a financialization where you have a beautiful product like mutual fund and beautiful vehicle like SIP, I think everybody, probably we also play a significant role. Radhika and MP also plays a very important role. We need to make sure number of players who advise the people and bring them into the investment side has to increase manifold from here. So I wish today we have 1,35,000 mutual fund distributors as an agent. That number has to go up at least 5 to 7 times in times to come. Then only we'll be able to have a significant growth from that side. Another thing, thanks to entire digital ecosystem, which has been changing very, very fast, I think the convenience of investing is now very, very easy. Whether you talk about onboarding or starting the SIP through Natch, or probably looking the portfolio on the platform, execution through the click of the button. So probably everything is now right as far as execution and the investments are concerned. What is requirement? What we require very seriously is handholding of those people to make sure they invest in the right direction, they remain committed to their goal, and probably we can bring more and more people to the fold.
Also, Sanjay, could you also explain us the current cost structure that investors need to understand maybe?
So probably if you look at the cost of intermediation is roughly in the range of, on the equity and hybrid side, I believe is in the range of 80-85 basis points, which includes 18% GST also. So if you invest through distributors, there will be a distributor commission which is paid by the manufacturer directly to us. If you go to AMC directly, then you'll save that cost, which is hardly about 70-75 basis points. However, when you look at the cost, you need to be mindful of the fact also that against that cost, are distributor able to generate alpha for us or not? Are distributor able to generate the extra return for the investor or not? And I can tell you there are n number of research which is available in the developed market like US. I can just give you a reference to one of the research which has been conducted by Merrill Lynch, which they talk about as the value of personal financial advice, and they bucket it. So if you look at the role which advisor is expected to play, would be starting from assessing the requirement to, let's say, asset allocations, probably coaching the customers or doing the behavioral coaching, or tax management. Probably I think very, very important thing would be the tax management, probably making sure that customer remain committed to his goal. Then the allocation among the various asset class. So these all things put put together, I think that Merrill Lynch report says that the advisor generate the alpha in the range of probably 250 basis point to 350 basis point. I'm talking about 2.5% to 3.5%. So against that average alpha which advisors generate about 300 basis point, I think 80 basis point is not a cost which somebody should keep in mind. And I can tell you these are the research of a developed market like US. And in case of India, still there is a huge need for us to people to bring into the market. So I think there is a lot of discussion about the distribution cost, but I believe that cost is not significantly larger. I can tell you another way also. Today, if you look at the country, there is hardly about 18-20,000 distributors who has the AUM of more than 10 crore who make serious money. So there is a really, we have a need for us to increase the number of advisors who can also make meaningful money.
All right, Radhika. Now there will be a second consultation paper on TER. We just want to understand what exactly was the representation done from the industry side, that the SEBI chairman said the industry would be very happy to see the second consultation paper or the changes that we made. What changes were proposed and what could be the new form?
Okay, so I think firstly, as an industry, I think we should be very happy that this is truly TER, which is such an important decision for our industry, has truly been a consultative process. As chairperson said, because this was price sensitive information, a particular draft of the consultation paper came out. Thereafter, the industry responded with feedback. I think most importantly, the industry responded with a lot of data to hopefully answer the regulators' questions. We are very happy that that has been heard, and a new consultation paper is coming out. Without going into too many details of what the industry said, I think what we've done is bring out data. For instance, let me give you an example that the chairperson also alluded to, so that this is reasonably public information. The fact that arbitrage funds do a high degree of churn. Now, that churn is not necessarily bad churn. It is done because you believe that you will generate higher interest, and buy sell is just the nature of the product. So I think the industry's job as practitioners is to highlight nuances, and then both the industry and regulators' interests is to work together finally for the growth of the industry. You'd recall at our Amphi office inauguration, the chairperson had called us the bada beta of the industry and said that mutual funds are the best instrument of saving or investing for the ordinary Indian. So I think we are all working towards that objective.
So Radhika, again, in continuity to the previous question, so what kind of changes would you think investors would be interested in seeing, or investor-friendly changes that one should be expecting?
So, it is hard to say till we see the consultation paper. All we have is one consultation paper, and some of the publicly made statements after the press conference. I think from an investor point of view, there has genuinely been nothing to worry. If I look at the last 10 years of regulatory changes, mutual funds have only gotten cheaper in terms of expense ratio. In fact, as schemes have scaled, the benefit of scale has passed on to investors. Mutual funds have gotten substantially more transparent in terms of the kind of disclosures that are out there. And a lot of risk practices, particularly in fixed income, on insider trading, conflict of interest, a lot of good risk and governance practices have been put in place. So I think this is an industry that has gotten more and more regulated, but in the right direction. And I think finally the fact that we are now almost a 45 lakh crore industry is also a product of the fact that regulation has made us the kind of product that we are.
Sanjay, your expectation from the second consultation paper, what kind of relief are intermediaries expecting? What kind of representation was done from your end also?
I believe probably, I think we also expect that I think the new version which will come would be very, very diluted one. And one important thing which I just wanted to highlight, the chairperson has already admitted when there was a press conference saying that the benefit of scale has already been transferred to the investors when they looked at the actual data. We are just going through one of the presentations which has been made by FIFA to the SEBI, where it has been categorically said by the FIFA that whatever has been the reduction in the cost cost has been borne by the mutual fund distributor, so which was about 9-10 basis point after significant TR cut came in April 2019. So whatever the benefit which has been required to be transferred has already been transferred to the investor. And probably, so frankly, I think what we have to look at with reference to the global best practices and the global cost structure, keeping in mind the size of the industry. So if you look at the 45 lakh crore industry, and on the equity side, if you earn about 85 basis point, and if you take out that GST, I think the earning is not in the range of 70-75 basis points. Zyada nahi hai. So probably I believe there has not been a significant scope for the reduction in the TR. What is required would be streamlining some of the things which is there in the mind of SEBI to make it all inclusive. There should not be anything outside the specified TR. If that comes without significant damage to the current structure, we all would love to welcome that.
All right, last question to Radhika, and then we wrap up the discussion. Radhika, what kind of intermediaries awareness programs do you as an AMC also conduct, in order to achieve the goal of financial literacy?
Absolutely, and I'll just point out 2 points. One, our team is always on the road. In fact, I myself am often on the road. And intermediaries are partners of AMCs. We think of them that way. And to work with them, in fact, to train them on how to showcase our products in the right way, how to use mutual funds as a genuine tool for investors is something that's very important. There's a second initiative that we've been doing every 31st of March. We declare it Financial Intermediaries Day. This year, we also released a very important report called the COGS, which was a tribute to the intermediary profession. And in fact, one of the most important things I must point out, the insight of the report was that if you look at longevity of investors, and investors that have stayed for more than 2 years of our assets, of Edelweiss mutual fund assets, the number, when you look at assets that came from intermediaries, was well in excess of 30% versus direct investors, which was 14%. So it's also sort of proving to the investor community that there is a benefit that intermediaries are giving you if you are choosing to seek advice. So that is a very important initiative of Edelweiss Mutual Fund, the whole Financial Intermediation Day, and that's going to continue and grow.
All right, I think that will be all. Thank you so much, Radhika and Sanjay, being on the show and helping our viewers with every aspect of mutual fund intermediaries. Thank you so much. All right, we move on in tonight's episode of IDFC First Bank Presents Leaders of Tomorrow. As part of our Wealth First special, we unveil the intricacies of the financial sector. In the first segment, Rajesh Saluja, CEO, Managing Director, ASK Private Wealth, shares his insights on the Hurun India Report 2023 and further highlights the right tools for wealth management. In the second segment, Anant Ladha, founder Invest Archfokal, elaborates on topics like debt management, borrowings, and much more. Listen in. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, despite the stock market ruling at record high levels, the inflows into equities as an asset class by Indian households remains in single digit, suggests a recent note by Jefferies. Investment into real estate, gold and bank deposits are still among the top drawers for savers. So why are investments in equities still in low single digits, and what can we expect going ahead? Let's get all these questions answered by Gautam Kalia, Vice President, Head Super Investor at Sharekhan by BNP Paribas. Gautam, good evening and welcome to the show. All right, so this report, we just had AMFI numbers come up earlier this week, and we saw record inflow again in equity and especially through SIP. But the report that we're talking about still shows that Indians have traditional investment instrument as their preferences when it comes to parking their money somewhere. What kind of a mindset are we talking about over here? And what's surprising that there has been a change after the pandemic, but then it's not still, considerable on the basis of which we could say that India is now an equity investment destination for Indians. We still can't say that, Gautam.
Yes. So, in fact, the report clearly highlights that, they've been publishing this report, this study since 2006. And in the last, 16, 17 years that they've been publishing it, what they found is that this is probably the third instance, where it's beaten 4%. And the last time it was in 2008, which was 4.2%, and then it was 4.3% in 2021, and now it's gone up to 4.8. Now this 4.3% in 2021 and 4.8 also maybe have to do with a little bit of the function of the market, with the market going up. But I think what is very clear is that that it's still very much below 5%. In fact, most years it's remained below 4%. And I think it's an extremely emotional decision investing still in India. And there are a lot of there's a lot of logic that people put when it comes to saving money and investing. There's a lot of thought process there. It's a consultative process, so you talk to your friends, family, and I think because of that, the conventional wisdom or the wisdom passed on from one generation to another still holds a very tight grip on the thought process. So I know so many people, even people who are in the investing field, they say, we are making investments in the equity market, but to what end? Ultimately, we need that money to buy a house, and if I can afford a house now by taking a larger loan, then I might as well do that. So that's another thought process. But I think with mutual fund Sahi Hai and the campaigns that started in 2017, with all that effort being put towards educating and informing investors, I expect there to be an increase, in this allocation, especially on the financial asset side. And that is something that the study also points out, that since 2014, gold and real estate, which are the physical assets considered as per their category, they have been receiving some share to cash, pension fund, insurance, mutual fund. All these financial assets, they've lost share by up to 8%, and that trend is consistent. So even though it may not be, even though mutual fund or equity investment may not be more than 5%, the entire physical asset allocation is now gradually reducing. But it's still very, very high. So just to give you a few numbers, for example, real estate is at 49% still, and gold is at 15. Bank deposits are at 15. So I think still very conservative approach. I guess with more education, people will get gradually more and more comfortable to invest in equities.
All right. Gautam, one more thing, that specifically gets highlighted is the lack of knowledge towards equity as an asset class. So it's not something that we are not aware of, and a lot of campaigns that even you've mentioned, were introduced with this entire purpose of financial literacy. And although we've seen a lot of things change since the pandemic, but then the bigger picture still remains untouched, and we are still not there. Maybe a few steps ahead, but then, we need to do a lot of things. So when we talk about lack of financial instrument knowledge, and when we talk about lack of investment in equities, what exactly is the myth now? What exactly is the understanding now? Where is it lacking? Or where are the wrong informations? Which are the wrong informations due to which people are not interested in this asset class, or that's holding them from investing in this?
So excellent question, Kavita. I think the first point really is, do people have access to information? Are there enough, I would say, avenues for them to get information on investing in equities in their language? We see in the industry data published by AMFI so many times that it is not the larger cities now that are growing rapidly. It's the smaller cities that are growing rapidly. So it's the beyond 30 cities that are growing, and that's really what is if that trend continues, then more and more financialization of savings will happen. More and more investors' allocation towards equity will increase. Now, when we come to the other point of what are the stories, what are the myths, I think the understanding of risk associated with equity investing, that is still, I would say, not there. And the reason there is that the kind of news, or still people remember, let's say, the scams, or the people taking a lot of let's say leverage and investing in equity, and losing all their wealth, and then you have these news of suicides. So I think those kind of stories, coupled with, let's say, a lot of fly-by-night operators, a lot of unscrupulous chit funds, or access to those which are offered locally, which offer great riches and then kind of turn sour. I would say, Ponzi scheme type traps, which maybe people are exposed to or have access to locally. And those kind of things also, they kind of share the same thought process, saying that, okay, this is similar to stock, so let's not get into it. It's better to keep it safe. At least putting it in a bank fixed deposit is safe. We don't have to go through all this. It's our hard-earned money. So I think that's really, those are the really other factors that come into play.
All right, so that's the current scenario or the pictures when it comes to Indians investing across asset classes. We'll take a quick break, but then post that, let's focus on our viewers' queries with Gautam Kalia. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Gautam Kalia, Senior Vice President, Head Super Investor at Sharekhan by BNP Paribas. So if in case you want to ask your portfolio-related queries, you can WhatsApp your question on 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. All right, so we move on, and we've got our first viewer online with us, Babu Papia. Good evening. How are you doing, sir?
Fine.
Okay, so you want to invest 5,000 per month for 10 years, and you are preferring a risky investment scheme, and your expectation is almost 12.5%, right? Return, yeah, expectation, yeah, return expectation. All right, got it. Sure, yeah.
Risk. So what is the best
You can-
investment and portfolio fund?
So you have a good risk appetite, is that right?
Yes, sir.
Okay.
Please suggest the scheme.
Sure, exactly. Gautam, although 12.5, I think is a decent amount of expectation, but I don't know if you want to go more conservative. He's got 10 years time horizon and 5,000 per month.
Right. So if I can ask, how much of your savings is 5,000 a month? Is it something that you want to start off with and then gradually increase, or are you looking to create a portfolio with the 5,000 investment?
I think he wants to start off with 5,000, but then do you wish to step up your SIP later on?
Gradually increase.
Gradual increase. Okay, Gautam.
So what I'll do is I'll suggest a couple of funds that you can start off with, and then when you start to gradually increase, then you can probably add a few more funds to your portfolio. I'm here assuming that you'll probably take your portfolio to a 10 to 15,000 rupees a month SIP eventually. So you can start off with something in the flexi cap space, where you're allowing the fund manager to take decisions on which cap to invest in, and something on the large cap side, where you're actually investing in some of the largest companies in India. So you can go in for, let's say, a Kotak Flexi Cap fund and a ICICI Prudential Blue Chip fund. And these two can be like your starting investments, and then gradually you can build upon that in your SIPs. 12.5%, typically the projections that we give are at 12%. Historically, the market has given 15 to 16% annualized, but there have been scenarios where the market has returned negative 30-40% as well. So really, that's something that you'll have to keep in mind, and you'll have to understand that volatility is the price of admission for investing, in equities.
Gautam, could you repeat the funds that you recommended?
Kotak Flexi Cap Fund and ICICI Prudential Blue Chip Fund.
Okay. In future, as he said that he wants to increase his investment amount gradually, should he be increasing the investment amount in these funds, or you would advise him to have one more fund in his portfolio?
Suggest an addition of a third fund, maybe like a balanced advantage fund. Uh, if he wants to add more funds in, more increases allocation. If he's okay taking a slightly higher risk, then probably I would suggest a small and mid cap fund, to add.
All right. Or maybe what he
But
can
that
do is
is
just send.
later.
Yeah.
That's later
Yeah.
once he increases.
Yeah, exactly. Or maybe what you can do is just send us your query again on the Money Show. Thank you so much for asking us your question. We move on. We have Mr. Ray on phone line with us. Hi, good evening. How are you doing?
Yeah, I'm good. How are you?
I'm doing good. Thank you so much. Okay, so at present you have Parag Parikh Flexi Cap, PGIM Flexi Cap, you have Navi Nasdaq, you have Kotak Emerging Equity, DSP Mid Cap, and Axis Small Cap. You've also, for diversification purpose, you've included Edelweiss, later China Offshore, and Axis Focused Equity in your portfolio. You seem to be quite satisfied with your portfolio performance, and there are a few funds, you're tensed about there, you're concerned about the underperformance out there. That's it. Is there anything else that you want to ask?
No, that's all.
All right. So clearly, it's DSP Mid Cap first. Gautam.
Yes.
He's been holding this since last 4 years.
Right. So, Mr. Ray, for DSP Midcap, what I'd suggest is that you can look at index fund. You could consider the Motilal Oswal Nifty Midcap 150 index fund as an alternative for your DSP Midcap allocation, which is about 5% of your allocation. And then you've got PGIM Flexi Cap as well as Axis Focused Equity. I think, yeah, you had asked also about the Axis Focused Equity Fund. I would say consider both PGIM FlexiCap and Axis Focused Equity to be moved to more large cap oriented if you are comfortable to like an HDFC Top 100 fund because that will reduce your it will increase your allocation to your large cap space which we believe you should have a little bit more of. So from an allocation perspective, the funds are okay, but from an allocation perspective, this would be better for you to do.
Gautam, one question to you. Why a passive strategy in a mid-cap space? Have you given up on all the fund managers?
So there are a few active funds as well, and I could advise, but maybe about 5 to 10% allocation to passive strategy in the overall portfolio makes sense, and probably even take it up to 20. So that's something that we are gradually incorporating in our conversations. But for example, there's a Tata small cap fund which we recommend as well. So there are some funds obviously in the small and mid cap space that we are quite bullish about as well, which we can consider.
All right. Is there anything else you want to ask, Mr. Ray?
I was suggested to go for the more large cap oriented, but I was saying Parag Parikh I have 40% of the allocation, and this PGIM Flexi Cap also it is 20%. So which are more large cap oriented. So considering the economy, actually I saw many of the analysts saying that the mid cap and small cap they are going to perform better in coming 2-3 years. So is it better to consider more allocation to mid cap and small cap instead of the large cap?
Gautam?
Telling our client, yes. Can you hear me?
Yeah, I can hear you now.
Yeah, so we do have a similar view. We are telling our clients to stay invested in mid and small cap space. In fact, over the 18-month period, we do expect this space to outperform. But the conversation here, I'm having more from a long-term investment. If you're looking for tactical, then you're right on the money. You can probably even increase allocation to the mid and small space. But if you're looking at a long-term stable portfolio, because it's always a balance. If you're continuously chasing returns, then obviously you'll get some volatility along with that. So if you're looking at a portfolio perspective, you could consolidate and stick to let's say a 40%, 50% allocation to large cap.
Let's move on, and we have Mr. Gajendra on phone line with us. Hi, good evening. How are you doing?
Good, madam.
You have Kotak Standard Multi-Cap, Mira Asset Large Cap, ICICI Pro Equity and Debt, HDFC Small Cap, Kotak Emerging Equity. And for how many years you want to be invested in this portfolio, in these funds?
So for the next 20 years, I will continue.
All right.
Investing
Any
in
target
this.
corpus? Any target corpus that you want to accumulate?
I have not set target, but I am stepping up
Okay.
every year by 10%.
That's lovely. Gautam, over to you.
Right. So your portfolio looks good, and in fact, you should continue with most of your schemes. I think the last one, which is the ICICI Prudential Equity and Debt, which is an aggressive hybrid. You mentioned that you're willing to take more risk and make the portfolio a little bit more aggressive. So you could move part of that to ICICI Prudential Blue Chip Fund, which will then increase your equity allocation and reduce your debt allocation. So maybe about 2,800 of your 4,000 can be moved there. But otherwise, I think your funds are all okay. Don't need to make any changes.
All right. With that, I think, Gautam, thank you so much for being on the show and helping our viewers with their financial portfolio queries today.
Thank you.
And time to sign off. But then before that, Pride Hotel Bengaluru is distinguished as one of the finest hotels, boasting exceptional amenities, top-notch services, and an ideal location right in the heart of the city. Whether you are a corporate executive or on a work trip or a leisure traveler looking to soak in the local culture and experiences, Pride Hotel Bengaluru is a bona fide one-stop shop and provides everything you need at one place. Take a look.